We are one day away from a major blow up somewhere in the US economy. Some company is going to go bankrupt with rising interest rates, and the systemic risk is going to rear its ugly head again, just the way it did in 2008. So at some point, Powell is going to cry uncle. The question is, how much pain is the Fed willing to endure? Powell claims it's willing to allow the economy to endure some pain. Well, I wonder how much pain they're willing to endure themselves when they get inundated with political pressure. You can already hear the cries from the Elizabeth Warrens of the world blaming the Fed for this collapse. In fact, the Fed is actually being set up as the fall guy to take the heat and to take the pressure off the Biden administration so that all the problems could be laid directly at the feet of the Federal Reserve. While everybody will be blaming the Federal Reserve for causing the collapse by raising rates too much, the real mistake that the Fed made was lowering them too much and leaving them too low for too long. Professor Jeremy Siegel was on CNBC for a long time being highly critical of the Fed, and he was correctly criticizing the Fed for being too loose in the face of too much inflation in 2021. But he wasn't being nearly critical enough when it comes to the Fed's inflationary monetary policies, which really date all the way back to 1998 and the long-term capital management bailout. That's when the Fed really started printing money, and then it printed even more money in advance of Y2K, and then even more money after the NASDAQ bubble popped in 2000, and even more money after the real estate bubble popped in 2008. So it's not just 1 year of excess money printing. The Fed has been too loose for almost 25 years, flooding the economy with cheap money. According to Professor Siegel, if the Fed had simply started hiking interest rates sooner, rather than claiming inflation was transitory, or ended quantitative easing sooner rather than later, then we wouldn't be having these problems. Fact of the matter is, the reason that Powell didn't act sooner is because he didn't want to create a problem by fighting inflation, because at that time, inflation wasn't a problem. Well, now that inflation is a problem, well, there's no reason for the Fed not to fight it. They didn't want to fight it in 2021 because it would have created a problem for the economy. Because now the inflation that they didn't want to fight, because doing so would have created a problem, has itself become the problem. And so they got a problem either way. They're damned if they do and they're damned if they don't. So that's why they're fighting inflation now. But even if they had chosen to fight it earlier, before it got this out of hand, they still would have created a crisis, because it's not just being too loose for a year. Again, it's 25 years of reckless money printing, of malinvestments and misallocations of resources. This is a gigantic credit bubble. We just added even more fuel to that bubble in the last year. So we just ended the mania with a more spectacular blow off top. But there was no way around this. There was no correct decision that the Fed could have made in 2021. So all they did is make the only decision that would allow them to postpone the pain for a little longer. They had no idea how much time they were buying by being that reckless, but they didn't care. Because again, the name of the game for the Fed is always don't create a problem. Even if it solves a bigger problem, wait for that bigger problem to become a crisis. It's amazing that so many so-called experts don't recognize the extent to which equity prices are at risk and how much lower they actually have to fall, to the extent that the Fed actually follows through with what it is claiming it's going to do with interest rates and this inflation fight. Because higher interest rates directly destroy stock market valuations. And there's 4 principal reasons for that. So let me go over those reasons so it's perfectly clear why what is happening right now with interest rates is very bearish for U.S. stocks. Even though they've already gone down quite a bit and are in bear market territory, they still have a long way to fall, because remember, stock prices were propped way up as a result of inflation and artificially low interest rates. So when you try to remove that inflation by raising interest rates, then prices are going to have to come crashing down to a level consistent with this new environment that companies are operating. But one of the reasons that high interest rates hurt stocks is because a lot of stocks have debt. And if you are a company and you have debt on your balance sheet, which of course corporations have record amounts of debt on their balance sheets, thanks to the Fed keeping interest rates so low for so long, lots of companies took advantage of cheap money by going into debt. And then what do they do with the money? They use it to buy back stock. But they bought back stock at inflated prices. In fact, as the stock market collapses, a lot of this debt comes due. A lot of these companies are going to be sitting on unrealized losses. They would have paid higher prices for the stock they bought, but now the money they borrowed to buy it is going to cost a lot more to service. And so as corporations that have debt have to pay bondholders more money to service that debt, that directly reduces corporate earnings. The only way corporations may be able to deal with that debt is by repaying it. Well, how are they going to repay debt? Well, they have to unwind those stock buys. They have to take the stock they bought and sell it into the market to get the money to pay off their debt. But of course, when companies go from share buybacks to share sellouts, share prices are going to collapse. And in fact, companies will probably have to sell more shares than they bought because the price is down. And so this weighs not only on their stock price, but on all stock prices. Now you have all this selling. A big driver of the bull market has been buybacks. Well, a big driver of the bear market is going to be sellouts as all the stock that was bought back gets dumped back on the market. There's another way that higher interest rates also affect corporate earnings, and that's because corporations have customers that also have a lot of debt. And so as their customers have to pay more money to service their debt, they have less money available to purchase the goods and services that a corporation may be selling. So not only are its earnings under pressure from its own increase in interest rates, but its earnings are under pressure because of its customers' increase in their interest rates. So earnings are collapsing as interest rates are rising. And stock prices, of course, are a function of future earnings. You have to discount future earnings into the present. So if those future earnings are going down, the present value is going down. But also, and this is another big reason that high interest rates hurt stock prices, is when you compute the present value of a future earnings stream, you have to discount it by an interest rate. Now, the lower the interest rate, the higher the present value of those future earnings. Now, as the Fed is raising interest rates, now you are diminishing the value of those future earnings. So not only are corporate earnings collapsing, but the present value of those diminished earnings is also collapsing. So rising interest rates actually deliver a double whammy to stock prices. Another way interest rates are going to hurt the stock market is by pushing the economy into a recession. And when we're in recession, there's also going to be huge job losses. And so all of those job losses are going to mean that a lot of customers are going to have a lot less income to spend buying the goods and services that companies have for sale. So earnings are just going to implode for all sorts of reasons. Debt service costs are going to explode. This is a disaster for the stock market. And of course, as interest rates rise, a lot of companies aren't just going to have trouble paying their debt. They're not going to be able to pay their debt. They're going to go bankrupt. And so a lot of these bankrupt companies are no longer going to be buying any goods and services from businesses that they used to patronize. And of course, the systemic risk is going to be there because when a company goes bankrupt and it can't pay its bills, now the company it owed money to isn't going to get paid. And so now maybe that company can't pay its bills either, and so on and so on. That is the type of systemic risk that caused the Federal Reserve to do quantitative easing in the first place. That's why we had all the bailouts in 2008, because we had all these banks that were too big to fail. Why were they too big to fail? Because if they failed, it was going to send shockwaves throughout the economy because of how interconnected everything was. And because of all the systemic risk, you let one big bank fail, it's just one domino, and now all the rest are going to go. Well, is the Fed going to do the right thing in 2022 or 2023 when it didn't do the right thing in 2008? What is the only reason that the Fed did the wrong thing? The wrong thing was slashing rates to zero and doing quantitative easing. Why'd the Fed do that? Because if it didn't do it, it was going to allow a lot of short-term pain. By doing it, it traded long-term pain for some short-term gain. In fact, the Fed made the same bad trade-off in 2020 at the onset of the COVID crisis. Instead of allowing the economy to endure the pain of dealing with the crisis, It slashed interest rates back down to zero, launched a massive quantitative easing program to postpone that pain. So again, it was short-term gain, but only at the expense of long-term pain. Well, the long-term pain is the pain that we're about to endure now. But the Fed had no stomach for pain in 2008 or in 2020. So they just postponed it to some future date by creating inflation. Well, now they're going to be in the same predicament that they were 12 years ago and 2 years ago, only now they're staring at a much greater crisis with even more pain.